Hello, everyone. Thank you for joining us today from your busy schedules to learn about venture capital and specifically deep tech venture capital. My name is Dr. Druv, and I'm humbled to host this episode of the financial and investor literacy episodic series called Files, because we all love acronyms in healthcare. So I thought of making one for this show. My mission, or PPI's mission, is to foster physician financial literacy. And because of stronger physicians, we can provide better care. Today, I have the pleasure of introducing Moien Giashi. He is a biomedical industry professional, material scientist, and researcher turned angel and venture capital investment professional. He is currently the senior investment associate at GreenSky Capital, leading deep tech investments. He also does product development, advisory, strategy, and business consulting for a broad spectrum of startups. He is a Vanier scholar with 18 published peer-reviewed research articles that have been cited more than 660 times, with industry-leading experience in nanotechnology, materials, 3D printing, and bioprint. Previously, he used to work with a venture partner called Archangel Network, and he was also involved with Baylis Medical Scientific Affairs as an associate, supporting their evidence generation, marketing, IP, and R&D. He has also been involved in the Toronto Senior Venture Manager, supporting a broad spectrum of companies and helped attract more than $12 million in investments. I'm really excited to speak to him today, and he's going to give us a primer into deep tech venture capital. Moien?
Yeah, hi, Drew. I guess thank you so much for inviting me to your financial literacy. What was FILA standing for?
Financial
Yeah.
and Investor Literacy Episodic Series. If you can't say the acronym, it means it's a very strong study.
Yes. Yeah. No, it's great. Yeah, it's great. And thank you so much for inviting me. I'm very happy to talk to you more about venture capital, specifically deep tech venture capital. How, I guess, is the landscape in Canada? What are the differences with angel investing? What sort of asset class we're dealing with here? So that if anybody decides that venture capital could be an avenue to explore for investment, then they have the right tools to make a decision.
Yes.
Cool. Yeah. So I guess I could start. So you kind of gave the background. What is interesting for me in my background is that I start from engineering PhD. I work at a medical device company, and then I sort of move more into entrepreneurship and venture capital, and that's kind of transition that I make. For me, the story is in a way that when I realized that when I was in the last year of my PhD, I kind of realized that there is a lot of things that I can do with this PhD in education beyond just becoming a professor.
Yeah.
There are probably other gaps in the society that I can fill. And then I was looking around, and one of the things that came across to me was that we are doing a lot of research, a lot of government grants and government money, taxpayers' money in Canada goes into very good universities that Canada has. University of British Columbia, University of Toronto, McGill, University of Alberta. We have at least one or two very good high caliber schools in each province across Canada. And they're producing a lot of top notch, like global scale research. And there's a lot of publications. And as you cited, I have 18 publications. There are a lot of patents coming out. But what happens after that? I guess the problem is that after that, nothing really happens. The patent sits there, the publication sits there. Another grad student reads my publication, cites it once or twice, and then moves on to the next project. And I was okay. What is the problem here? Then the problem is really commercialization stage. So grad students, professors, they're not really trained to commercialize products, and government supports the institutions that do research up until the research is delivered, but they don't do anything to deliver the research to solve an actual global problem. So I kind of realized that's the problem space that I want to be at. Like, I want to be at a place where I can support commercialization of deep technical research, and specifically research that can have global impact. that was kind of my idea.
So you
The
wanted to
problem
transition from basic research to applied research and
from
monetize
basic
it.
research to using research for monetization,
Yes.
basically. So, and I transitioned to working at Creative Destruction Lab, which is an organization across Canadian MBA schools. A bunch of them have a Creative Destruction Lab branch. What they do is that they kind of host these research projects that have potential for commercialization. They have probably gone through the first step of formation and help them reach the market, understand who the customers are, et cetera, et cetera. So for me, that was kind of the jumping board. I didn't have a lot of business knowledge. All the business knowledge came from reading books.
Yeah.
And once I worked at Creative Destruction Lab, I came across a lot of very technical startups on one side and a lot of venture capital firms on the other side. And I could see firsthand how venture capital firms, how advisors who would probably the previous founders of companies would advise these startups to grow and scale and find their path. So that was kind of my entrance.
Yeah.
And then after that, I realized what are the things that I don't know and I have to hone in. So the business skill sets, business lingo that I needed. And then after some time, I joined GreenSky Capital, where kind of the role that I found for myself is someone who can lead the deeper technology investments, diving deeper into the technology that a startup has, understanding if the technology is real, understanding if it actually works, understanding if it is actually solving a problem or not, and then being able to translate that technology, that market need into a commercialization opportunity for, let's say, partners of the firm and other members of the team who are probably coming from different backgrounds. And I realized that's overall in the landscape of venture capital, that is, at least in Canada, that is the role that is kind of not really seen. So we see a lot of VCs with, let's say, finance background who end up investing in healthcare companies without really having that healthcare background and knowledge that is required. And that happens a lot, and that can cause, I guess, a lot of these investments not to go well as they should. So I guess with that introduction, I can kind of open up what is a deep tech.
Before we get there, I know that as part of these episodes, we did cover the spectrum of business investment. But could you just tell us in the spectrum, where does venture capital lie? Everywhere from like an idea in someone's mind, in an entrepreneur, to IPO. Like we hear IPO, we hear the S&P 500, right? So where does venture capital lie there? And then you could get into why you chose even GreenSky Capital or Deep Tech Venture Capital. Yeah.
Sure. So I guess my answer would have two sides. One is that from the investment deployment side, and then the other side is that in terms of investment management.
Okay.
So from investment deployment, in the lifetime of a company, it starts from an idea, it grows a bit, probably needs a bit of money to create a minimum viable product and test MVP. It. That's probably the stage that maybe friends and family or angels come in. It grows a bit, the product becomes a bit completed, it starts generating a bit of revenue, not a lot, maybe one or two customers. Friends and family are just too small at this point, so angels would write bigger checks. Few VCs write very small checks as well. I would probably call them nano VCs. They have micro VCs and VCs, but these are very tiny funds, maybe 5-10 million that write like 200K checks. And then we have like, I guess, regular earliest stage VCs come in with a check of 500K to maybe 1.5 million for rounds that are 3-4 million. So the company has created the tool, has generated some substantial revenue, now needs a lot of more money for the next 2 years to be able to sell more. So hire a strong sales and marketing team, but also do a bit of more R&D so that they can maybe build a solution that is bang on and like covers all the customers' needs. So a bit of R&D, but a lot of sales and marketing. maybe 3 million rounds would be enough. Take them for 2 years. After that, they go to a growth stage, and then Series B, C, and then until there's an acquisition or there's an IPO. So this is in terms of, I guess, deployment, where the investment amount is 500K to up to, I would say, 10, 20 million. So earliest stage venture capital firm up to growth stage venture capital firm. That is the spectrum of venture capital firms. So anything after angel investing and before IPO can still be venture capital.
Yes.
And so it just depends on what is the size of that fund, who provides the money to the venture capital fund, and what is the check size of the venture capital. So this is in terms of the deployment.
Okay.
The other side that I see for this is that, let's say you are a high net worth individual. What would you do with your money in this spectrum? You can be that friend or family. So you could be that angel who goes in and directly writes a check, or you could be a limited partner of a fund and basically contribute to the fund. The fund manages your money and does the investment on your behalf, obviously takes management fees, takes profits, or you end up just investing in public companies. So this would be your spectrum if you are the investor and you have your own money. And so
that's
when
actually
you want
a good way to look at it from a management perspective, because we tend to look at it from the deployment perspective. So
so from the management perspective, if you want to be an angel investor, then you have to do your own research. Probably you join an angel group. The angel group usually helps with sourcing deals. They would have monthly, quarterly meetings. You would join those meetings and see the startups, and then decide whether you want to write a check. Maybe it's a 25K check, maybe it's a 100K check, depending on your capacity. The problem is that you really haven't to spend a lot of time to do your due diligence. You are not really diversifying your investment. So if you write 4 25K checks, that's 4 investments and 100K. You're still not diversified in terms of probably the type of investment that you do. If it's, let's say, a healthcare investment venture, a healthcare angel group, then you're just investing in healthcare companies. So in terms of the type of industry, you're not really diversifying your investment. You might also join another venture angel group and invest in other type of companies as well. But when you go to a venture capital firm, you put in 100K, 200K, whatever that is, and then through the life of the fund as they're deploying, let's say the first 3 years is the life of the fund deployment, they might invest with the pool of fund that they have into 20 companies. So you have obviously diversified your investment. People who do the investment have been doing that probably for multiple years before. They are doing that as their full-time job. So it's their job, it's their life. Their life is to do deal sourcing, is to do due diligence, is to find the best investment to increase the multiples on everyone's money. Usually, I guess, one of the things that potential limited partners can look into is that how much money do the principals of the fund have into this specific fund? Is their money also in this pool or not?
So skin in the game.
Do they have a skin in the game or not? And like there are funds where you can see that a large portion of the fund comes from friends, family, and the partners of the fund. And there are a lot of high net worth individuals. There are institutions as well. But it's a good balance of skin in the game, bunch of high net worth individuals, and money from institutional investors, which allow the fund to be able to actually invest an initial smaller check, a follow-on larger check, and kind of keep the diversity of the investment. So that's sort of the I guess the landscape of how you enter in investing in a fund. We can maybe talk more about how to decide whether a fund is good for you or not.
Yeah, go ahead.
I mean, one of the things to take a look when you want to decide whether an investment fund is actually good for you is definitely the life of the fund. So you have I guess emerging funds, which is when they're in their fund one or fund two, so they haven't really invested a lot before. Maybe the size of the first fund or the second fund is like 5-10 million, so it's not very large. They probably have like 5-10 like companies in the portfolio. So this is a fund that is a fund manager that is in early life of being a venture capitalist and fund manager. And then you also have fund managers who have been doing this for 5-10 years. They're probably invested in like 20-30 companies. The good thing is about a fund manager that has a lot of experience is that you can kind of explore what was the track record. One of the things that I guess when I told you this the first time, you told me, but the historical result don't kind of justify or guarantee future results. That's 100% accurate, but that is the best, I guess, data point that you have
That's
when
the
you're trying to choose.
process of investing in a human environment, right? Like when
Yeah,
you're in a human environment, like yeah, like that. I mean, for some people, it's exciting because the human element is what could create more returns. Or yeah, past performance is not an indicator of future performance. So
yeah.
and that's that.
That
I mean, there's
that's
no way
yeah.
around that. That's just part of
There's
like
no way
financial
around that,
systems in the world.
unfortunately.
Yeah.
Yeah, there's no way around that for sure. But at least that shows that okay, people who are managing this fund previously have made a couple of good decisions.
Yes.
Again, venture capital, they say it's a power law game. It's kind of the odds game. If you have one or two kind of home runs that can cover up a lot of losses and a lot of like investments that completely go to zero. So again, we want to make sure that the investment fund has been able to actually capture a bunch of home runs, a bunch of mediocre like 2-3x
Yes.
investments. We have to be comfortable with investments that have gone to zero, because that happens in every fund.
Yeah.
It's just nature of investment. But
Yeah.
what is important is that did the investment manager in picking and choosing the portfolio have that diversity of investment, a couple of home runs, a lot of kind of mid like 2-3x, and obviously a bunch of zeros. So that's kind of the thing that you want to look into, besides the experience of the fund managers. um, One thing that I like a lot myself is as a strategy against a spray and pray. So a spray and pray strategy is that you decide to write 50 200K checks, which is 10 million, into
Okay.
50 companies. You're just spraying your money into 50 companies, and you're waiting to see what happens. You
Okay.
basically don't have any strategy, and you're just relying on normal distribution to give you enough return, so that your fund actually becomes double or triple.
Okay. I don't know if it has
That's not
50, but
so that's not a good strategy. Like usually good investment funds have a specific strategy, a specific thesis in their investment. For
yes.
example, they say we wouldn't invest in B2C companies because we think that we can't understand consumer behavior. Or they say, oh, we only invest in D2C companies because the founders of the fund previously have founded a bunch of D2C companies. They've succeeded. Now they know how to scale and help other D2C companies. There's nothing against being B2C or not being, or being D2C or not being. Or like the fund says, I only invest in B2B companies because I know the growth and success in B2B companies are more aligned with my experience and my background. I can add a lot of values. I have a bunch of very technical people in my team. I have a lot of connections in, let's say, manufacturing and industry. So I'm going to go with like industrial innovation B2B companies. And again, what is this stage? There has to be a thesis behind it. Like I would go in early because I want to take on a lot of risk, but I would also be able to add a lot of value. I would also be able to dictate the valuation early on. So I would kind of get outsized multiples. Or I would go in at Series A with a 10 million check because I want to kind of reduce the risk, reduce the upside, but reduce the risk, get like 3-4x. And if I can like double or triple a 500 million fund, that's actually a big deal. As the fund size becomes
Yeah.
bigger,
Spoken like a true venture
make
capitalist.
yeah. So that would be kind of the different theses that different venture capital firms have. I would say usually venture capital firms that would invest larger check sizes, so like in the growth stage, they would not go to high net worth individuals for money. They would go to institutional
Yeah.
investors. So maybe Caterpillar is your investor, maybe RBC is your investor, maybe BDC is your
Yeah.
investor. But and then you have the capacity to write a 10 million check. So a high net worth individual's investment might be maximum 2, 3, 5 million. They can't like fill up a 500 million. I mean, there are people who can,
Yeah, they
but,
could.
but usually, generally speaking,
Yeah.
they can't fill up a $500 million fund. So usually venture capitals that take high net worth individual folks' money are early stage, Series A stage, and they're targeting a up to $100-200 million fund, which can be like they used to invest for 3-4 years, and then they target the next fund after that. So to sum up, experience of the fund manager, having a thesis, the previous performance of the team, and kind of the stage at which they're investing is the metrics that a new investor that is seeking a venture capital fund should look into. And again, something that I advised against was a spraying and praying, because you
Yeah.
invest
Like
in quickly and you decide.
I mean, it's just so anxiety provoking when you said it, even spray and pray
Yeah.
technique. And actually it's actually excellent, because by talking about venture capital, you actually covered the aspects of due diligence, right? So generally on the angel world, you're doing the due diligence, founder due diligence, business due diligence, or whatnot. But in this case, if you're going with a venture capital fund, you cover the aspects of the due diligence of the fund, and because they are doing the due diligence on those companies. So now you don't have to do double due diligence, so to speak. You just have to do your knowledge seeking information on the fund. So you covered, the important aspects of the investment fund manager, the track record, the sponsors, the team, the markets that they look into, and the type of returns that they've been able to produce. And yes, the disclaimer is past return is not an indicator of future performance. So on that note, then let's dive into your field. So tell me more about deep tech.
So yeah, I guess deep tech, the way there are a lot of different kind of definitions for deep tech. I kind of wrote one article called "Why Deep Tech is Important and Why It Matters and Why We Should Care About It." And I start with basically this disclaimer: deep tech means different things to different people.
Okay.
So you might ask me what is deep tech, I tell you something, and then you might ask someone else and they tell you something else. But overall, the overarching and something that I see as deep tech is a technology that, first of all, it took a lot of expertise and it took a lot of time and R&D to be developed. So it's, if you are a 12-year-old who can write an app because you have access to YouTube now and you have access to a lot of tools and you learn how to write code, you shouldn't be able to replicate a deep tech company, because either you haven't done a lot of research, either you need a specific knowledge, let's say a specific skill set, or you need a specific experience in a specific field to be able to create a solution that we call deep tech. So there's basically a border between this startup and the outside world and competitors, and that border is built because of that skill set, because of that experience, or because of that R&D that is done. And that's the IP, that's the moat that protects the company. And we're not just looking for protection here, but we're looking for a solution that is different to large massive global problems. So when you were talking about global warming, you can't really write another app and expect to reduce carbon emission. There are a lot of different aspects of the problem that you have to resolve. There's transportation, there's energy storage, and each of these problems are massive in their own right. and they require a lot of R&D, or they require, let's say, someone who has worked in the energy field for 20 years, and they've realized that, oh, there is actually this inefficiency. Maybe at the end of the day, the solution is a software, but the software solution that is created to solve the problem is created by someone who has 20 years of field experience. They are the only one who know what is the problem. They are the only one who knows what is the gap. But that 12-year-old who knows how to code would not know. And this is
Can
kind
you
of
give us
what
an
we
example? Like, so you gave YouTube, so now I know, okay, that's not deep tech because yeah, a 12-year-old can write that code. So give me an
no,
example.
when I mentioned YouTube, I mentioned it because as a means of education, like if you can watch YouTube and learn how to code. I didn't mean to mention YouTube as an example
Oh, I
of
see.
not deep
Okay.
tech,
Okay.
but I would have basically two columns: a shallow tech versus a deep tech. Shallow
Yeah.
tech is you are 21-year-old, you go to your dorm. This is your first time away from home. You realize that dorm doesn't have proper dry cleaning. Maybe I can write an app that comes that someone comes pick up my clothes and wash them and then do the dry cleaning and then return it to me.
Okay.
That's a shallow tech
Okay.
because there are, first of all, 50 different types of those. This is basically the small business of today. Like there are so
Yeah.
many
Yeah.
platforms like this. So and everyone can come up with the same solution. There's nothing there.
Yeah.
A deeper tech solution would be you. Let's say I have a live example. You have done your bachelor's, master's, PhD in civil engineering. So you are kind of expert in construction space. You have done a lot of research. You have done a lot of optimization in, let's say, construction management. You've realized that construction is one of the areas overall globally that generates a lot of carbon emission,
Okay.
and you realize the solution for reducing carbon emission in the construction industry is to, first of all, optimize the design of the building so that the building itself reduces its energy consumption. Second, you can actually let's imagine you could disassemble your building and then change the layout of your building, or you could sell the doors, windows, and concrete walls of your building after you demolish a building. What happens is that you don't need to produce a new window, you don't need to produce a new door. As a result, you are reducing the emission. The problem is that creating a solution that can manage all of this, both in terms of design and in terms of management, is very complex.
Yeah.
It requires multiple parallel optimizations at the same time,
Yeah.
both in terms of the management, in terms of design, in terms of material choice, et cetera, et cetera, et cetera. So it's very complex to create a solution like that, but it's actually a solution that is very much needed. So right now, a big corporation can go to consultants. It takes them 12 months, 24 months to just come up with a feasibility analysis of how to do this. Imagine if you had a solution that could do this in a click of a button.
Yeah.
That solution can be created only if various experts with many years of R&D come together and can disrupt this market. Otherwise, the solution would always be, let's go to that engineering consulting firm and spend a bunch of money, 24 months, to come up with a solution that might not be optimized either because a human came up with it.
Yeah.
But this other tool exists that uses AI and can do a lot of optimizations, generate 10,000 designs for you in a matter of seconds, and you can just like move a toggle around and change your optimization and then come up with a design that you like.
So
Deep tech, shallow
software.
tech.
So software like operating systems would be in there. Kerbal Space Program. It's a video game that just came out. Like Kerbal Space Program 2 came out. So it has various. I mean, it's more on rocket design and exploration of space, or a shallow tech would be like your tax filing. Like your tax filing would be like shallow tech, right? Bunch of brackets, tax brackets. You fill that in, and you can make an Excel sheet out of it. Okay. So now that we understand the difference between the two, it's why is GreenSky Capital only looking at deep tech? Is it because you have found better returns, or because your team has experience in this field, and so they're sticking to the experience that they have? Why is that?
So I guess I would clarify that GreenSky also invests in B2B SaaS companies.
Okay.
They're still complicated technologies. They're not shallow tech
Okay.
as in they're still software, but they need a lot of expertise to build. But we also have a specific niche of very deeper technology companies. I mean, the reason that we have chosen those is that first of all, we think that they are diamonds in the rough.
Okay.
So not everyone has the capacity to actually evaluate companies like that. One of the very important jobs of a venture capital firm when they make an investment, beside choosing where to invest, how much to invest, is to get a good deal in their investment. So if I invest $1 million in a company that is $10 million in valuation, I just bought all of my limited partners 10% of that
Yes.
company. But if I could go in and understand the company and nobody else understands the company and I can negotiate and I can get a good deal and let's say invest that 1 million in a $5 million, what happens? I just double the ownership for my limited partners. I just
20%.
bought
Yeah.
them 20% of that company. So we think with the specific skill set that the team members have, so we have someone with 30 plus years experience as being CTO of manufacturing, ICT, IT. So that person can definitely go in, understand the technology, understand the need of the market, talk technology with the founders and say, and basically understand whether they're BSing or everything is actually working. And then decide whether this is actually a good investment or not. While a lot of other firms would not have that capacity because a lot of team members are just coming from a finance background.
Okay. So it'll be very
So
similar
that's
to
kind of
the very similar to the skill set, for example, of a physician who's worked for 30 years. They will be able to pick apart within reason certain healthcare startups because they basically have a lot of experience in that field. Now, because it takes whatever a decade to produce a physician, with that plus you're adding 30 years of experience, there's not many people like that available in the market, and so you or this particular section of venture capital is capitalizing on the skill set of an individual to be able to recognize where the upside could be.
so that's I guess that's one part of it. But then the second part of this is just the fact that the problems that you're facing
Hmm.
in today's world are so challenging that we should just move on from a tax filing solution. We should move
Yeah.
on from a reusable packaging solution. Those are good businesses. They're businesses. They can generate revenue, but they're not venture backable. They're not massive. They're not scalable. They can't solve global problems. And if I can find something, if I can find a solution that improves the efficiency of lithium ion batteries by 10 times, I just found gold. I
Yeah.
can sell it for anything I want.
Yeah.
And that solution doesn't come in the form of an app. That solution doesn't happen in someone's garage. It really happens by someone who has a PhD, has done a ton of research in probably a university lab or an institution lab. They might do it in their garage if they have a lab, but they have to have the knowledge and the skill sets to be able to design experiments and do a lot of R&D to come up with that formulation that makes the efficiency of a lithium ion battery 10 times better.
So are
Um,
all AI companies deep tech?
so I guess if I put us back, like what would be deep tech? If like okay, AI would be deep tech, but are all AI companies built the same? So
Yeah.
I mean, from the spectrum of me using regression to very complex neural network algorithms, people call all of that AI, which is
Yeah.
obviously
Yeah.
ridiculous. But if I mean, like definitely, if you have come up with a new algorithm, a new solution, let's say we all hear Chat GPT now, we all hear about the language models, etc. Okay, so these are new, these are different, these are not
Yes.
just off the shelf algorithms. This is not just regression. It took people a lot of time, money, and energy to come up
Yes.
with it. You can't just randomly come up with it. You can't use like basically use an off the shelf solution to come up with this. That's definitely a deep tech
Okay.
solution.
Okay.
Um, a lot of advanced material companies are deep tech solutions. So if you have a new nanomaterial, if you have a new hydrogel that can have biomedical applications, if you have a new battery composition, these are all advanced material companies that take a lot of research and R&D and field expertise to be able to actually come up with. So it is kind of the same. Like I can tell you that as a supply chain company can be a deep tech company, but it's a software. How is it deep tech? Because the person who is actually providing the solution to solve the supply chain issue have worked 30 years in supply chain,
Yes.
knows the gaps, knows where things go south,
Inefficiencies in the system.
and they might just pull up something off the shelf as an AI solution, but they ultimately are able to solve this problem. And it's a problem that me and you who haven't worked in supply chain,
Yeah.
even though we know there's a supply chain problem, and even though we are very smart, we can't solve. So I would call that deep tech too, because it just takes a lot of effort and energy and years of experience to come up with.
Okay. Now, let's say okay, so now we understand where we are in the business spectrum. We have covered, a bit deep tech. Let's say now, okay, I'm convinced and I believe this is the future, right? I want to place some of my capital into this particular section because I have hope, not spray and pray technique. So, are there many companies, or sorry, many venture capitals across Canada with the expertise that is available in your team? If not, uh, how can a physician get involved?
So, the first part of the question is that, like, are there many venture capital firms? If that was the question, there are not as many venture capital firms in Canada as, let's
Yes.
say, there are in the US.
Yes.
But at least CVCA, Canadian Venture Capital Association, every year publishes a list of top 50 venture capital firms in Canada.
Oh
So
wow,
there
I didn't
might
know that. Okay.
so there might be family offices, there might be smaller venture capital firms that are emerging. They might not be part of that top 50, but I think that top 50 would be probably a less risky, more reasonable way to start. Like looking at that list, you would realize that there are a bunch of VC firms that are very active in early stage. So
Okay.
early stage meaning seed round or Series A round. Being very active or being very making selective investments doesn't mean too much. You're just too active. It means that you have invested in more companies. You're less active and more selective. It just means that you have invested in fewer companies. You might invest in fewer companies but with larger checks, or you might invest in a lot of companies with smaller checks. So that really doesn't matter. But there are different areas that folks focus on. So there are a bunch of VCs that are like absolutely generalist. So they don't care if it's B2B, if it's B2C, if it's D2C, or if it's a barbershop, whatever it is they invest in, and they call it venture capital firm. Nothing against them. It's as long as it makes money, that's great. There are a group of venture capital firms that only invest in healthcare companies. So there's one in Vancouver. There are a bunch in Quebec and Toronto area. So those have folks that have expertise and experience in pharma or in medical devices. There are different ones. Some of them don't invest in medical devices, only invest in pharmaceuticals. Some of them invest in medical devices as well. But again, that's they can folks can find that in that list of top 50 CVCA companies. And I guess if you have a link in your YouTube, you can definitely add that as well. It's a PDF that they produce every year.
Yeah, I actually just looked up the website, and I might include that in the description in the YouTube or description in the links. Yeah. I mean, I didn't know about it. I mean, going back to that concept, just because you're a top 50 VC firm doesn't still give you a guarantee, right? It just gives you track record.
So a top 50, and here are the metrics to be top 50. The total asset under management is a metric. So how much money over the years you've been managing?
Yeah.
Is it 200 million? Is it 50 million? doesn't tell you anything about the return. It
Yeah.
just tells you that you have been able to secure a lot of money.
Yeah.
That could mean that you have had a good track record or not. So,
Yeah.
for example, BDC, nothing against BDC folks, but BDC is the most active, I think, Canadian fund. It is supported by the government, but the return, and I mean, limit, like high net worth individuals cannot invest in BDC.
Yeah.
BDC only invests in companies. But looking at the track record of BDC, the return is not really like if BDC was a private venture capital firm, it couldn't raise another round of funding, basically,
Okay.
because the return is at multiple is not very strong.
Yeah.
So. So again, the activity, the size of the investment, that really doesn't mean much. But I mean, specifically for the case of BDC, the goal is not just to make returns. It's obviously there's a different goal. The goal is to help innovation move forward.
Yeah.
As you remember, initially I mentioned government invests a lot in research. So then government is trying to bring on organizations like BDC, EDC, who can invest. Organizations like SCTC, Sustainable Development Technology Canada, who can give grants, and they do a lot of due diligence to provide these grants, and sometimes the industries that they support are slower in growth and they might not give a lot of return, but overall what they do is critical for growth of the country. So it doesn't matter if as a specific investment that return a lot or not. So that comment is not very fair that I had. But so if you check that list, total asset under management, the number of team, diversity of team, number of investments that they have had over the years, these are all metrics that matter for a company to become, for a VC firm to become part of the top 50. There are, as I said, different types. There are types that only invest in software. There are companies that are generalists. There are companies that only invest in healthcare. There are companies that come in at later stages, so Series A later. And then there are companies that also come in very much earlier. So there is a bunch of distribution that you can find in that document.
Okay. So, so I guess the question now is why should a physician get involved in deep tech through GreenSky Capital or other venture capital firms?
So I mean, I guess like just irrespective of GreenSky or not, what I would say is that venture capital is an asset class, just not the same way that real estate is an asset class, but it is an asset class. So real estate, venture capital, public market, these are different types of asset classes. A physician or anybody else can own different types of asset classes. Some of these asset classes are risky, some of them are less risky and more stable. Some of them give you a property. So real estate gives you a property, it's tangible, you see it, it depreciates, that we can rent it out, etc., etc. Venture capital is obviously a very risky investment. So I guess the first thing that I want to make sure that we share with folks is that VC investment is highly risky. If it's highly risky, doesn't mean that you shouldn't invest in it. It means that you have to have a logical allocation of your total net worth into that asset class. It might become 10x, which is amazing.
Yeah.
But it also all of a sudden might become zero.
Yeah.
So, and I think it's wise to have like 5 to 15% of one's total assets in venture capital. If things go south, it becomes zero. It's not that bad. You still have 80-90% of your asset, but the upside is massive in the case of venture capital. So you put in 100, you take out 500K, that's 5x. And a good venture capital firm usually does provide that kind of return. And that's usually the promise that you will make your money 5x. It takes some time. So this is the other thing, that venture capital investment is, and these days more often than before, is a patient capital. So you put in money, you don't have access to the money, it stays there at least for like 7 years. That's the standard, I guess, of the market. And I mean, while your money is there, you might receive returns as companies exit, but your money is there and your money is hooked and you can't take it out. There are, I guess, innovations in venture capital where you can sell your shares and kind of exit to some other LPs. Not all firms have those kind of opportunities, and it's not a common thing. So usually the money is actually hooked for a long period. So that's the second item to know. The third is that I guess you want to invest in an area where you see the future is going. So after COVID, what happened is that people realized they stayed home. The global temperature changed a bit. They realized, oh, if we actually don't move and we don't produce a lot of emission, things can change. So they realized that, and then also because COVID happened, they realized that like end of world can happen if we just continue to not care about the world that we live in and just like try to use SpaceX to go to Mars. So they realized that, okay, like we all have to invest and contribute to clean air technologies. So technologies that that lead to alternative energies, technologies that would reduce emission, technologies that would capture CO2, etc. So it is now in a way that these technologies that, let's call them clean tech, are almost recession proof. So it doesn't matter that you're in recession. People are investing in these technologies because governments are changing their mandates. The population's behavior is changing. Everyone is expecting companies that they buy things from to follow clean technology and follow ESG and be transparent about their ESG metrics, etc. So clean tech companies are kind of becoming the future, the recession-proof future, and that's overall across what we call deep tech. Solutions that are solving largest global problems are going to be the future. So I want to put my money in the solutions that would solve the global problems, not just apps and not just another chocolate bar that I can sell across Canada. So as you realize,
you're spending a lot of time on other venture capital firms.
so
it's true though. It's true because like
it's true. So I
my own investment thesis.
Money.
Like my investment thesis, you know, as a physician was like, oh, I'm only going to invest in healthcare tech startups because that's all I know. But there has been I suppose this investment thesis of I want to make the world a little bit better. And as you said, you know, 5 to 15% of your capital in order to make this world better. Where would that, you know, where should that go? And so I've been looking a lot into ag tech and clean tech. Although I did do a fair bit of research into fintech as well, but you know, at this stage, it's just at the research level. Like I'm just doing a lot of research into these particular verticals, so to speak. But clean tech for sure. Like it's you know, it's just very pleasing to the heart, right? The world is going to be cleaner, greener, and I'm going to be involved in it, leave a better planet for my children. So it's like, oh, and I don't want to be involved in that. It's a little bit difficult, right?
And you can't have a clean tech company that is not deep tech. So a clean tech solution is a deep tech solution because there's a lot of research and development goes into it to be able to come up with a solution that really solves the global problem. So that's where I want to put my money. Whether I want to put it in GreenSky or any other firm, I would go talk to the people of that firm. I would maybe
the due diligence elements that you covered, right? You covered those due diligence elements. So I would recommend the viewers, you know, listen again. I have my own due diligence checklist for venture capital. The principles are the same. No matter, you know, I mean, there are some specific concepts to understand in the various verticals of venture capital, but the fund itself, the principles, you know, as Moien covered here, you know, the investment fund manager, the track record, the check sizes, the spectrum, all those, you know, what at least from my own experience don't change. So that's the skill set one wants to build, you know, in order to be able to invest into, you know, venture capital. But go ahead.
Yeah, and I mean, you mentioned the other than the fact that people have to do their own due diligence, one of the other metrics that I wanted to mention is that a good firm is one that spends a lot of time understanding the technology, is one that can add value beyond investment.
Yeah.
So because then they can direct the company into the right direction, they can help the company sign large agreements, they can help the company exit, and these are skill sets that that the partners of a fund should have. They should be able to make an exit, and like having an exit, having a merger is probably one of the most challenging things that a company would go through. So having someone on board who has the experience of managing an exit is key. So like, can I actually go and find the company that would buy my portfolio company? Or can I actually negotiate a good deal with that company to buy my portfolio company? Or no, they're just gonna buy it cheap and I'm gonna lose money and not return good money. So not all exits are the same.
Yeah.
Not and not all venture capital firms are the same. So
Yeah.
the way that they operate, the composition of the team, the thesis of the firm, all of them are different, and a high net worth individual should do proper due diligence to understand which firm to choose to invest in.
Yeah. I mean, I think we we were chatting for at least like 45 minutes or more. So, is there any other concepts or topics you wanted to cover that I didn't ask? Or, I mean, I have just some few basic questions like, what is the quintessential VC book you should read other than Venture Deals? Because it has the word Venture Deals in it. But
I would say the answer would be Secrets of Sandhill Road.
oh wow, I've
Um,
never heard of it. Okay.
this is a book by Scott Kapoor. So it dives deeper into how a VC is run. It might get a bit technical. So it talks about the term sheet, the LP-GP agreement,
Yes.
how much profit would GPs take, how much profit would go to LPs, what is the management fee. So that kind of gets into the weeds of the dynamic of how a VC works.
Oh wow. Yeah, like I'm looking it up right now. Wow. I didn't even hear about this book at all. That's great.
Yeah,
Thanks for the recommendation.
it's this is a good one. Yeah, and if you any of the physicians would like to hear and I guess learn more about the startup side, I think if you haven't read 0 to 1, if you
Yeah, I
haven't
read that
read
one.
okay, if you haven't read Eric Ries's Lean a Startup, that's a very
I
good
read that
one.
one.
Hopefully, you have read Hard Things About Hard Things. That's also a good one
Okay.
by Ben Horowitz of Andreessen Horowitz. These are the top three, I guess, on the startup side.
The hard things about hard things.
Yes.
Horowitz. Okay. Yeah, like I mean the classics, like Venture Deals, Peter Thiel's 0 to 1, Lean Startup. I also read Disciplined Entrepreneurship. That's more for the entrepreneur side. All of like when I actually took the Mars courses on entrepreneurship, so that's where they covered a lot of these books. And because, as I said, I have an interest in this space and ecosystem. And you can imagine, right? Like as a physician, I spent a lot of time trying to master my skill set. So I would not have the skill set to do due diligence on deep tech. But but then I don't want that to just stop my potential, right? Oh, I can't be involved in clean tech because that's not what I studied in university. Well, then how does the rest of the world, again, going back to the human aspect, right? There are other ways of adding value into this world other than just what you studied or how much money you have, right? So,
Hmm.
and that's the whole reason for creating these episodic series is that yes, we are experts in healthcare, but we could also venture into the other aspects and add value into those other aspects. Because if everybody else was doing it, we would have enough capital, not just in just wealth or money, but like human capital, relationships, who to contact, how to get things done, how to execute a business plan, how to come up with an idea, how to get that idea into a concept or an MVP, how to monetize it, all those aspects, right? Because that's a massive deep tech right there.
Yeah.
So yeah, thanks a lot, for spending your time, taking your time to cover these aspects. Yeah, did you have anything else you wanted to cover or topics that we didn't cover?
No, I mean, if I guess folks are interested about clean tech, they can see articles that I write on LinkedIn.
Okay.
If there are any questions, I would be very happy to respond to. Yeah, you can share my email as well.
Okay, so I'll include your email, your LinkedIn profile, and the CVCA link in the description when this video goes live. But thanks a lot for your time, and hopefully in the future maybe we can do a more focused session on clean tech where you get all the hard questions.
Sure, absolutely. Thank you so much.